Crypto markets have steadily weakened through June. Bitcoin is down around 15% this month. Ethereum and Solana have seen even deeper pullbacks, and trading volume across major crypto assets has reportedly dropped to its lowest level in nearly 2 years. And at the exact same time, parts of the AI trade have also started wobbling. And I don't think those two things happening together is a coincidence. For years, crypto people talked about crypto like it would eventually separate itself from traditional markets. A completely different financial system, a hedge against the old system, a parallel economy. But what we're actually seeing now is crypto becoming increasingly connected to the wider technology trade. Welcome back to the channel. If you are new here, my name's Paula. On this channel, we look at stories shaping crypto, markets, and the future financial system in a way that normal people can understand. And before we get into it, every Friday, 7 p.m. UK time, me and Milkshake Matty co-host the UK Crypto Podcast. It's right here on YouTube. You can also watch it on Spotify and on TikTok. And we break down what's really happening in crypto and global markets without all the hype. So, let's look at this story. Over the last couple of years, AI became one of the biggest narratives in global markets. Anything connected to AI exploded. Nvidia, Oracle, supermicrocomputer, chip manufacturers, cloud infrastructure companies, data center businesses, billions and billions of dollars flooded into companies connected to the AI story. And for a while, it felt unstoppable. But this week, the market started asking harder questions. Not, does AI matter? That part seems obvious now. The real question is, how expensive is the AI race becoming? And are the markets already pricing in too much future growth? One of the biggest stories this week was Oracle. Oracle actually beat earnings expectations, but the stock still came under pressure after concerns grew around the scale of spending needed to compete in AI infrastructure. Reports suggested the company could dramatically increase capital expenditure tied to AI and cloud expansion over the coming years. And Oracle wasn't the only company feeling pressure. Parts of the semiconductor sector also weakened this week. Broadcom came under pressure after softer guidance. Supermicrochip computer saw sharp weakness. Some AI-linked trades started rolling over after becoming extremely crowded. And once markets start questioning valuations, things can move quickly. And honestly, this is the part I'm still trying to fully process myself. You hear these companies talking about spending hundreds of billions on AI infrastructure. And I think a lot of normal people are probably wondering the same thing. What are they actually building all this for? And then I heard a podcast the other day talking about the race towards AGI, artificial general intelligence, which basically means AI moving beyond narrow tasks and becoming capable of reasoning, learning, and operating across many areas, more like human intelligence. Now, whether AGI actually arrives in 5 years, 10 years, or much later, nobody really knows. But what's important is that many of the biggest companies in the world increasingly seem to believe it's possible. Some major AI leaders have publicly suggested AGI level systems could emerge within the next 5 years. And once you start looking at it through that lens, the spending race suddenly makes a lot more sense. These companies aren't just competing to build better chatbots. They're competing to build systems that could eventually automate huge parts of the economy itself, not necessarily by replacing every human job overnight, but by gradually becoming integrated into how businesses operate day to day. Customer service, research, scheduling, software development, data analysis, fraud detection, advertising, logistics, financial systems. Finance is probably one of the biggest examples. Markets generate enormous amounts of data every day. Human beings simply cannot process information at the same speed as machine learning systems trained on huge data sets. So, if AI becomes increasingly integrated into trading, liquidity management, and financial infrastructure, Markets may become faster, more automated, and increasingly machine driven over time. And I think this is why companies are spending so aggressively right now. Whoever builds the strongest AI infrastructure potentially gains enormous economic advantages. Not just better products, but faster systems, better automation, stronger data analysis, and huge efficiency advantages across entire industries. That's why this isn't being treated like another app launch. It's being treated like a race for future infrastructure. And once you start looking at markets like that, the recent weakness across crypto suddenly makes a lot more sense. Because this isn't just a hype cycle anymore. Markets are trying to price in what AI may eventually do in the global economy over the next decade. And I think retail traders are already starting to feel that shift happening. Markets move incredibly fast now. One headline drops, algorithms react, liquidity shifts, leveraged positions get wiped out, and retail traders are still trying to work out what even happened. This week, the AI linked crypto project Sahara dropped sharply, with reports suggesting around $23 million in forced liquidations during the move. And moments like that really highlight how aggressive these markets can become once liquidity starts disappearing. Machines react instantly, risk systems react instantly. Meanwhile, retail traders often react emotionally afterwards. Now, obviously, algorithmic trading isn't new. Institutions have used automated systems for years, but the scale and speed of machine driven markets does feel like it's accelerating. Liquidity disappears faster, narratives rotate faster, volatility spreads faster. And if AI systems become increasingly integrated into trading, risk management, and financial infrastructure, that speed probably increases again. Now, on one hand, that could create more efficient markets, but on the other hand, it may also create an environment where emotional retail trading becomes even harder. Institutions can afford algorithms, they can afford automation, they can afford infrastructure. Meanwhile, retail traders are often still reacting emotionally to headlines and candles after the move already happened. And I think that's why so many people online feel frustrated with markets now. Not necessarily because markets are rigged, but because the structure around trading itself seems to be changing very quickly. AI isn't changing chatbots and search engines anymore. It's starting to become part of how financial systems actually operate behind the scenes. How markets analyze information, how liquidity moves, how risks get managed, how trading firms make decisions faster than human beings realistically can. And whether people like that or not, it does feel like markets are becoming increasingly machine driven over time. Now, personally, I don't think humans suddenly disappear from trading tomorrow, but I do think understanding automation is probably becoming more important. Not from some get rich quick angle, more from understanding the environment markets are moving into. And this is part of the reason why me and Milkshake Matty started exploring automation trading ourselves. Not to sell fantasies, more from trying to understand how these systems work, how automation fits into modern markets, and how normal people can actually approach this world safely without disappearing into weird Discord rabbit holes. That's why we made the free TradeBot Pro course. We just keep seeing people online saying, just use a signal bot, but that doesn't actually help beginners. Most people don't know how bots work, how to connect them safely, how demo accounts work, or how automation trading even fits into their life. So we made a completely free course, walking through the entire process step by step from start to finish in around 30 minutes. No fake promises, no guaranteed profits, just helping people to understand the tools that are increasingly becoming part of modern markets. Because I think we're at a time where we need to start thinking about whether AI and automation actually are improving markets. Do you think retail traders risk falling further behind as finance becomes increasingly machine driven? I'd love to know your thoughts in the comments. And if you want to know more about the automation side, the free TradeBot course is linked in the description below. This week wasn't just about crypto pulling back. It wasn't just about AI stocks wobbling. It was a reminder that markets themselves are changing. AI is no longer some futuristic side narrative sitting outside the economy. Companies are spending hundreds of billions building what they believe could become the infrastructure for the next phase of technology, automation, and finance. And whether that ultimately leads to AGI or not, the race itself is already changing how markets behave. And retail traders are trying to adapt to a financial environment that increasingly feels machine driven. And I think over the next few years, this conversation around AI, automation, and finance is only going to get bigger from here. If you enjoyed this video, make sure you like, subscribe to the channel. Thank you so much for watching, and I'll see you in the next one.